Hey, good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. So summer months, obviously, there's still a ton of stuff going on. A lot of that chatter is in the rate market. So let's kind of get right down to it and bat around a couple of topics today. Now, look, overall rate levels in general, we've seen, ironically, a considerable backup on the long end of the Treasury curve. We had the Fitch downgrade. Look, a lot of those issues were already known. They were out there in the marketplace. Sometimes it takes a catalyst to set off some of these duration moves. But in general, look, I mean, the pain trade in the market, you look at the structural portfolios, you look at the regional bank issues that we had in March, and let's be clear, the pain trade in the market is still higher rates, less so on the short end, but certainly more so on the long end, and that's certainly what we've seen of late. We've seen real yields moving higher. So the question is, are we getting more term premium into the marketplace when we look at the long end of the curve? We have had longer term inflation expectations inching a little bit higher, but I still think it's a little too early to tell right now. Good 3-year, decent 10-year. 30-year wasn't a catastrophe in the grand scheme of things, just not as strong as the 3 and the 10-year, and certainly different participants within that sector, but no real follow-through. So a redistribution here as we got through the inflation data and yields continuing to move higher here. Now, we've been following real yields, certainly 30 years out toward 2%. We look at 10-year space at 180, but do yourself a favor. I mean, go back and look historically. If you think this is a bigger picture move here in the context of where we've been, cut out this time frame of 2010 to 2018, look at where real yields on the long end were over time, over decades. So yes, locally right now we're at some pretty key levels, but in the grand scheme of things and the bigger picture of things, depending on what your viewpoint is, cyclical or secular, things don't necessarily look as cheap, but certainly locally here, we are fighting a battle, and 10-year reals in and around 180 to 182. Brings me to the yield curve. Look, bear steepening. At the same time that the Fed is probably, we're going to hear from the Fed minutes this week, the potential for the Fed to perhaps notch a little bit higher from here, although we think they want to be done. They're certainly at a minimal, it's going to be higher for longer. We have 5 rate hikes priced into 2024. So that kind of leaves us in this position right now of this bear steepening. Look, if you go back and look at bear steepening trends, we've had a lot of these trades. We've traded yield curves forever in the marketplace. Bear steepening trends, they come and go, right? The real functional moves in yield curve happen when the Fed is actually driving that. So in 2022, lifting short end rates, we've got this extreme flattening into inverted levels that we haven't seen in a long time. And then conversely, when the Fed does actually lower rates, I mean, we see the curves further out reacting first as we price in those rate cuts. As the Fed actually comes in, they start lowering rates, and typically we'll have a bull steepening. Now we're having a bear steepening. So at some point, and we did see a little bit of this into the auctions, they kind of run out of steam. The long end becomes really, really cheap. Real money accounts come in to buy. And that's a little bit of what we saw before the auctions. So we'll see how this plays out now, short term and 10-year space. Jackson Hole, we have the FOMC minutes this week. Look, the Fed has said 2 more rate hikes. Look, inflation's come down. You look at core inflation, even last week, it's still pretty sticky, so it's not coming down fast enough. At a minimal, the Fed is higher for longer. We do think in the minutes you're going to hear this flavor of the potential for 1 more rate hike. At the same time, look, this market is hungry. It's been hungry for rate cuts. We've been at the forefront of pushing back on all this rate cut nonsense, certainly for 2023. Cognizant of minefields that short term the Fed has solved with 13.3 programs. So now the market has said, okay, fine. We've conceded on 2023. We've conceded on the recession. It's a soft landing narrative, whatever that means. And we're pushing these rate cuts now into 2024. So let's see how that goes. But, short term Jackson Hole, secular changes in the economy, structural changes in the global economy. We know this economy is changing very quickly. It's changing before our eyes. We have geopolitical risks, which are front and center. We see the news flow that's coming out of China. We see the pieces that are moving around the globe. They have inflationary consequences, no question about it. Cyclical versus secular, there are different opinions out there. Certainly a school of thought that thinks we're going back to pre-COVID type ways. And there is a school of thought that is saying, look, some of these COVID dynamics, maybe not all of them, will change this inflationary dynamic going forward. That is something to watch here as we get lulled to sleep in these summer months, move into the fall, the end of the year. We've seen headline inflation come down a lot. We've seen PPI come down from 10% to a 2 handle. We're seeing commodity prices now move higher. We're seeing food prices move higher. We're seeing long end yields move higher. It's something to pay very close attention to as we head into the fall months and the end of 2023. It does not mean the Fed is going to tighten significantly more. Certainly they could notch up one more time, but we think they're pretty close to that resting spot. But if inflation does continue or start to tick back up the other way, it certainly bodes higher for longer. It emphasizes the case for the Fed to leave rates on hold higher for longer. And then lastly, on the ground this week, we get a ton of housing data. We'll get a fresh look at where the housing market is at. As we said in our morning meeting, note to file, mortgage rates are on the move higher here with 10-year yields moving higher in this pocket of time. Is the Fed going to be disturbed by that? Well, when you look at services housing inflation, still sticky, probably not. So we'll get a fresh look at that. We certainly get retail sales, so we get a look at the consumer, and we get the FOMC minutes. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of US rates for AmeriVet Securities.